While most people are arguing over the next election or the latest stock trend, three quiet shifts are already rewriting the American economy for 2026. This isn't a theory. It's already showing up in layoff filings, refinancing data, and jobs reports. Most people just haven't connected the dots yet. Here's the conflict. The institutions that manage your money are already repositioning for what's coming. Major banks are preparing for AI to eliminate hundreds of thousands of back-office roles. Nearly $900 billion in commercial property debt is coming due this year alone. And the labor market that everyone calls strong just posted its weakest hiring numbers in years. None of this is speculation. It's already sitting in the data, filed in earnings calls and government reports most people never read. If you're still running your finances on a 2020 Playbook, a savings account, a 401k on autopilot, and a job you assume is stable, you're standing in the exact spot where these three forces are about to collide. And here's what makes 2026 different from every other economy is changing video you've watched. This isn't one crisis. It's three separate pressures building at the same time, in the same year, hitting the same group of people. The working and middle-class professional who assumed their job, their savings, and their retirement account were all separately safe. They're not separate. They're connected. And that connection is the actual risk. Over the next few minutes, I'm going to walk you through exactly what's happening inside corporate America's AI restructuring, inside the commercial real estate debt market, and inside the monthly jobs reports most people scroll past. Then I'll show you the specific, practical moves that let you turn this disruption into an advantage instead of a casualty. This is not the crash video you've seen 100 times. This is the map nobody's giving you. Let's begin. Forget the AI hype cycle you've heard about for the last 3 years. What's happening in 2026 isn't a someday story anymore. It's a quarterly earnings call story. And it's happening at companies whose names you already know. Since the start of the year, Oracle's workforce has dropped from 162,000 employees to 141,000. And the company openly admitted the restructuring is tied to its AI-centered strategy. Meta laid off 10% of its staff in a single announcement, while simultaneously reassigning thousands more employees directly into AI-focused roles. Cisco cut 4,000 positions, and Cloudflare's own CEO went public, writing that the company eliminated a fifth of its global workforce specifically because AI had removed the need for middle managers, operations staff, and parts of its finance and compliance divisions. This is not a handful of isolated headlines. Industry analysts at Gartner project that roughly 1 in 5 organizations plan to use AI to flatten their management structure over the coming years. A shift that could eliminate more than half of today's middle management roles industry-wide. And the trend is accelerating in real time. AI was cited as a direct factor in roughly 13% of all U.S. layoffs so far this year, up from under 5% in 2025. That's nearly a threefold jump in 12 months. Here's the part most people miss. Finance and banking, an industry many people consider safe and recession-proof, is actually one of the most exposed sectors right now because so much of its workforce sits in administrative, processing, and customer service roles that AI systems already handle at scale. Office and administrative support jobs make up a larger share of employment in the financial sector than in almost any other major industry. Executives at J.P. Morgan, Citigroup, and Goldman Sachs have all publicly acknowledged that AI will eliminate a meaningful share of these roles over the next few years. This isn't about robots taking every job overnight. It's about the latter quietly disappearing. The entry-level and mid-level roles people use to climb through on their way to financial stability. When that ladder gets automated out from under a generation of workers, get a stable job, and save consistently, stops being reliable advice and becomes a plan built on an assumption that no longer holds. And this isn't limited to tech companies experimenting with new software. Tracking data from Challenger, Gray, and Christmas shows technology firms alone have cut well over 100,000 jobs already this year, With AI now the single most frequently cited reason companies give for those cuts. More than economic slowdown, more than restructuring, more than any other explanation. Think about that for a second. Companies aren't hiding this anymore. They're putting it in press releases because investors reward it. While AI reshapes the job market from the inside, a second pressure point is quietly building in commercial real estate. And this one moves in dollars, not headlines. According to the Mortgage Bankers Association, roughly $875 billion in commercial and multifamily mortgage debt is scheduled to mature in 2026 alone, about 17% of all outstanding commercial real estate loans in the country. Some broader industry estimates, once you include loans already extended from 2024 and 2025, put the real number closer to $1 trillion moving through the system this year. Here's why that matters to someone who's never bought a commercial building. Much of this debt was financed between 2015 and 2021, when interest rates sat near historic lows, often 3 to 4%. Owners refinancing now can face rates nearly double what they locked in years ago. Combine higher rates with falling office valuations in major U.S. cities, where vacancy stays near 19%, and you get an unavoidable math problem. Many owners can't refinance at the old numbers, and lenders already know it. This is a kind of stress that ripples outward from a boardroom into ordinary finances. It moves into regional banks, holding these loans on their books. It also moves into pension funds and insurance portfolios that hold commercial property as safe, diversified exposure, and eventually into retirement accounts of people who never thought about office buildings when they picked a fund. Office space is where this pressure concentrates hardest. Vacancy is near historic highs, and office loan delinquencies have been climbing, with more loans requiring special servicing just to avoid default. Multifamily housing and industrial property are holding up far better. Occupancy stays strong, and lenders remain comfortable refinancing those deals. This isn't a story about real estate crashing. It's about which parts are under real stress and which are becoming buying opportunities for investors who understand the difference. Most analysts call it a slow-moving maturity wave, not a 2008-style collapse. But it's real, quantified, and already in motion. The third piece of this puzzle is the one hiding in plain sight. Inside a jobs report most people scroll past without a second thought. Recent government data showed the U.S. economy added just 57,000 jobs in a single month, a sharp slowdown from the pace seen earlier in the cycle, while the unemployment rate sits at 4.2%. On the surface, that headline number still looks fine, but underneath it, financial sector and tech sector payrolls have been shrinking by an average of roughly 28,000 jobs a month this year, even while the broader labor market looks stable. This is a disconnect that actually matters. Economists at institutions like Yale's Budget Lab and Barclays note that this isn't showing up yet as dramatic, headline-grabbing mass layoffs. It's showing up as slower hiring. Companies aren't always firing existing employees because of AI. More often, they're simply choosing not to replace the people who leave, retire, or quit. One senior economist at Barclays put it plainly: some of this is genuinely productivity, replacing workers. But the pattern showing up across earnings calls looks far more like a cost-cutting exercise dressed up as an AI story, driven by how much companies have already committed to AI investment. Either way, the effect on an individual worker is the same: fewer open positions, longer job searches, and less negotiating leverage than the 4.2% unemployment headline suggests. That's a quieter, harder to see version of the same disruption we talked about in part 1, and it hits new graduates and career changes the hardest, because the entry points into stable careers are exactly the doors that are closing first and quietest. Put these three forces together: AI hollowing out the job ladder, nearly $1 trillion in property debt resetting at higher rates, and a labor market that's quietly cooling underneath a fine headline number, and you get the real 2026 story. Not one dramatic crash on a single day. A slow-motion repricing of what financial stability actually means to the average professional. The old playbook said, get a degree, land a stable job, save consistently, and let your 401k compound quietly in the background for 30 years. That playbook assumes the job ladder stays intact, the labor market stays predictable, and stable job is a status that, once achieved, doesn't need to be questioned again. In 2026, all three of those assumptions are under real, measurable pressure at the same time. This is also exactly where the diversification most people practice quietly falls short. If your paycheck, your savings account, and your retirement fund all depend on the same labor market and the same financial system absorbing the same shocks at the same time, you aren't actually diversified in any meaningful sense. You're concentrated inside one economic weather system, just spread across a few different containers. None of this means the sky is falling. The U.S. economy is not collapsing overnight, and treating every year as the year everything breaks is exactly the kind of fear-based content that burns out an audience instead of actually helping them. What's different about 2026 is specificity. These aren't vague warnings about the system. They're named, dated, source pressures with real numbers attached to them, converging in the same 12-month window. That specificity is exactly what makes them worth planning around, instead of scrolling past. So, what do you actually do with all of this, not panic, position? First, audit your income concentration. If your paycheck depends on a role that's heavily administrative, repetitive, or sits in the middle management layer we talked about in part 1, that's not a reason to panic tonight. It's a reason to start deliberately building a second skill that AI systems still struggle to replace. Complex judgment calls, deep client relationships, hands-on technical work, or anything that requires navigating genuine ambiguity rather than following a repeatable process. Second, understand your exposure to the debt wall indirectly, even if you've never touched real estate. If you hold broad real estate funds, regional bank stocks, or employer-sponsored pension products, it's worth spending 20 minutes actually checking how much commercial property exposure sits inside them. You don't necessarily need to sell anything or make a dramatic move. You simply need to know what you actually own, instead of assuming diversified fund automatically means protected. Third, treat "I have a stable job" as a temporary state to keep re-earning, not a permanent status you unlocked once. In a market where hiring is slowing at the same time automation is accelerating, building a second income stream, a portable certification, or a client base outside your employer isn't a trendy side hustle idea anymore. It's the closest thing to genuine insurance available to an individual worker right now. Fourth, separate cash you'll need soon from cash that can absorb some risk. With borrowing costs staying elevated and refinancing pressure building across the system, this isn't the year to have your entire emergency fund and your long-term growth money treated identically. Money you might need in the next 12 to 18 months belongs somewhere stable and liquid. Money you won't touch for years can afford to be positioned for the disruption we've just walked through instead of sitting passively and hoping it doesn't get caught in it. None of this requires panic. It requires attention, and it requires starting before the pressure becomes obvious to everyone else at the same time. The people who come out ahead of a slow-motion shift like this one are rarely the ones who predicted every detail correctly. They're simply the ones who started adjusting early, quietly, while everyone else was still calling 2026 just another year on the calendar. That's the real wealth compass for this year. Not fear, not doom, and not a false alarm about a digital currency system that doesn't even exist. Just an honest source reader where the real pressure is actually building before it becomes a headline everyone else reacts to 6 months too late.